County Finance and Budgeting Committee meeting for Wednesday, November 19th, 2018 will please come to order and the clerk will call the roll.
Calling the roll, Mr. Miller.
Here.
Mr. Jones.
Here.
Ms. Simon. Ms. Simon is absent at the moment. Mr. Tuma.
Here.
Mr. Gallagher.
Here.
Mr. Sharon.
Here.
Ms. Brown. Here. We have a quorum. Also like the record to reflect that Councilwoman Baker is also in attendance.
Okay, thank you very much. And has anybody signed in for public comment?
No, Mr. Chair, no one has signed in.
Okay, next item on the agenda is approval of the minutes from the November 5th, 2018 meeting. Those minutes are in your packet. Does someone have a motion relative to those minutes?
Move to approve?
Okay, it's been moved by Councilman Schron and seconded by Councilwoman Brown to approve the minutes as presented. Any further discussion? Hearing none, all those in favor say aye. 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 Any opposed? Okay, the minutes are approved. And the first item on our agenda is the review of the third quarter financial report. I would bring to everybody's attention that normally at this time we would be starting the off-year budget update process. But instead this year we have granted the administration's request that because of the ERP installation, which would complicate the budgeting process, we have agreed to defer that, and that the budget changing will be done through fiscal agendas, which we expect in January or thereabouts. And but we're still required under the charter and the county code to receive an update of the same regular information that's provided in the budget. That is to say, the receipts, the expenditures, the review of the capital plan, and such things. I'm gonna pull a Zig Berzins here. He always likes to start his presentation by saying that I'm going to start by telling you some good news. And the good news is that in the third quarter update that the projected deficits for next year and 2020 and down the road have narrowed from what they were in the previous update. So that is a positive report, and the director will tell us more about that and other things. So now I turn it over to Director Keenan.
Good afternoon, Maggie Keenan, Office of Budget Management. So as I always do, I'm going to run through the major funds, highlight some of the key issues. Interrupt me if you have any questions before I move on. That's totally fine. So looking first at the general, do you need to make this bigger? Okay. Looking at the general operating fund, which is separate from the 0.25% fund, this is the county's main operating account. In 2018, we have a projected $18 million budget surplus. That means that our spending levels are $18 million under approved appropriation levels. In 2018, however, we do have a $32 million operating deficit, which means that expenditures are under revenue by $32 million. The cause for that is largely attributed to capital projects. The general fund has advanced, in some cases advanced, and in some cases is just supporting capital projects, including the Harvard Garage Project, the Cleveland Police Headquarters, the ERP, and those had not previously been reflected as expenditures. They were reserves on balance. Now they're in the operating projections, and so that's causing that deficit. The cash balance was sufficient to cover this draw on reserves. In 2019, the operating shortfall increases to 33 million. Right now, we are over approved appropriation levels that were adopted for 2019 by about $30 million. So that will have to be corrected, or at least we'll ask for it to be corrected on the first fiscal agenda in January, as Councilman Miller indicated. Again, this is largely attributed to capital projects. I have on the slide the detail, but it's Harvard Garage, the county jail, that's the renovation of the old kitchen, the ERP, and I'm including demolition as that's a one-time draw on reserves. I do want to note that the Harvard Garage project is in advance. That's a $23 million project. About $21 million is going to eventually be repaid by the road and bridge and sanitary funds. So our cash balance based on these projections is within the GFOA recommendation of 17% through 2019, but we fall below to 14% in 2020. Based on our current projections, that cash balance is projected to drop down to 3% in 2022. So that assumes no changes to revenue or expenses. Any
Okay,
questions?
Director, how much is the operating deficit for 2018 and 2019 if you back out the capital expenditures, including the demolition?
For 2018, it's about $10 million. For 2019, $3 million.
It's 29, three? Only three? Mm-hmm. Okay. Why is it higher in 2018 than 2019?
2019, we have some assumed increases in revenue, including the sales tax. We are assuming now increase in revenue in property tax as a result of the sexennial appraisal. Wouldn't hit obviously in 2018. And then we had some other one-time costs in 2018. I can get you details on all those, but we've had a lot of capital projects in 2018 that were holdovers from the previous year.
And can you give us, what's the schedule on the payback for the Harvard Garage project?
That's 1.1 or 1.3, I think it's $1.3 million for about 20 years. 90% of that project is coming from road and bridge and sanitary. It's 70% sanitary and 20% road and bridge.
Okay.
Mr. Chairman?
Yes, Vice President Jones.
Maggie, why isn't demolition captured in 2018 as it is in 2019?
In 2018, it's included in the operating deficit. So in 2018 though, they were still drawing down cash that we had put into the demolition fund in previous years. So if you remember, we had that reserve set up in the budget. In 2018, they are going to draw on that about $2 or $3 million, and the bigger chunk is going to be in 2019. And then that reserve is going to be gone.
So the reason it's not reflected as a capital expenditure, highlighted might be a better word,
That's
Say
an
it one more time.
That's an oversight on my part. So there
Okay.
is a couple million that was drawn in 2018 for demolition, and I'll confirm that with the staff later. But the it's a $5 million draw next year, and the reserve was $8 million. Actually, is Anthony? Are they going to hit it in 18? Yeah. Okay. So. Then I was right. In 2018, there's not a draw on the reserve. But in 2019, there will be of almost $5 million.
Okay,
Sorry.
thank you.
We welcome Ms. Simon to the meeting. Any further questions on this section? Please proceed.
Okay. So the next slide is the 0.25% fund, as everyone now is sick of me saying. The county increased the sales tax by 0.25% in 2007. This sunsets in 2027. This is largely used for economic development, though the funds are legally unrestricted. They can be used for any general fund purpose allowable by law. In 2018, we are projecting about a $1 million operating shortfall. The budget had assumed about $1 million in revenue from the CCCFDC as reimbursement of prior year surplus that we are not going to be receiving. The 2018 estimates do include a transfer of $6.5 million to the general operating fund, and the ending cash balance is projected to total about $42 million, which is 78% of total expenditures. In 2019, we're projecting an operating surplus, which means that revenue is greater than expenses, of about almost $1.5 million. There is a decrease in the subsidy that the general fund is going to have to provide to the hotel debt service. And again, this does include the $6.5 million to the general fund, and it does not assume the reimbursement from the CCCFDC that we had assumed would come this year. The ending cash balance at the end of 2019 is projected to total $44 million, which is 86% of total expenditures. There is an increase in our spending out of this fund in 2020. The Medical Mart debt service increases by $4 million, so we are projecting at this time an operating deficit in 2020 of nearly $3 million. And then in 2021, we're assuming no change to revenue and expenses. So again, a $2.8 million operating shortfall. Any questions?
So for 2021, you would also be assuming that $6.5 million transfer to the general fund, even though it's not specifically listed?
That's correct.
Yeah, okay. Okay, anything else on the 0.25% fund? Am I correct that a little bit farther down the road outside of this forecast period, we get to a point where we're expecting there to be expenses for hotel upkeep and renovation that would draw on this fund? Is that correct?
Yes. So we have a separate FF&E account with the trustee for capital expenses located at the hotel. We deposit a certain amount of money every year according to a schedule. Based on our projections, which are really the projections of the county's asset manager, because I don't know about upgrading hotels, that fund in that balance is going to be short in 2025 by about $7 million. So we do have a reserve on balance that's reflected in the schedules to take care of the hotel costs in 2025. According again to the asset manager, we have to do complete room renovations beginning in 2023, I believe, which are supposed to take place over a period of 3 years. And that separate fund will cover the first year or so, and then we fall short. To your point though, Councilman, that $7 million is obviously insufficient to cover the hotel's needs for the rest of its useful life, and the general fund is the reserve for the hotel.
Okay. Anything else? Okay. Yes. Ms. Simon.
At what point are we going to see the cost benefit analysis of, having this hotel and what benefits we're reaping from having the hotel in connection with the convention center? Is there ever going to be a way to really quantify this equation, this spend?
I'm sure there is a way to do that. Looking at the larger picture, that might be a Destination Cleveland project. From the county's perspective, we can quantify how much the county gets in bed tax, in sales tax. I can tell you those revenue sources are never going to come close to what we're paying in debt service for the hotel. So from the county's perspective, the cost benefit is going to be kind of a soft benefit in terms of larger economic activity, which is not to minimize that impact, but just in terms of dollars and cents, it's going to be red for the county.
So wouldn't our sales tax revenue reflect that soft benefit? Is that
sure.
really, that's it for us? Basically, at least straight up,
Right.
revenue from this.
And the bed tax.
And the
so
bed
we do get bed
tax.
tax, which bed tax supports a number of activities, throughout the county. But those are the two primary indicators for us. And we, I mean, sure there's a way to track the sales tax from the hotel specifically, but then I think, like I'm saying, at Destination Cleveland, I feel like they might be able to do a better job to really say what's the economic impact of
They're
this.
good at that. They're good at.
Yeah.
Chairman?
Yes. Councilman Tuma.
Yeah, thank you. Director, as far as that, I think you referred to it as was it furniture, fixtures and equipment? How much in that account is there for the hotel?
Do you know what the balance is right now today? So right now, there's a balance of $1 million? So right now, there's a balance of $1 million in that account. It's held with the trustee, and we deposit a couple $100,000 every year, right? 600? Yeah. About six?
Okay.
So we deposit, and I think the percentage is actually increasing next year, but so we do deposit based on revenue, a certain percentage every year, and that's been about $500,000-600,000.
Okay, all right, great.
The hotel, I'm just a little bit more on that. The hotel does submit a capital plan to the county every year. So the money that's going in, a lot of it is used on an ongoing basis. It's not all building up for that room redesign in 2023.
Okay.
Okay, so the next slide is looking at the general fund. Now, this is the general fund combined, so including both general operating and quarter percent. For 2018, we are projecting an operating shortfall, which again means that expenditures are greater than revenue of about $33 million. This is largely attributed to the general operating fund, so again, it's those capital projects. In 2019, the operating shortfall decreases slightly because the quarter percent has a surplus to $32 million, and then it decreases again to $20 million in 2020. Right now, based on our projections, the cash balance will be above the code requirement of 25% through 2019, but in 2020, we are going to fall below the minimum required by the code, though we are still above the GFOA recommendation of 17%.
So the county code requirement of the 25% refers to this combined general fund.
That's correct.
Yes. And what accounts for the reduction from 32 million to 20 million in 2020?
A lot of it is those capital projects. So
Okay.
in 2019, we have about $30 million in the budget that are one-time expenses. We always have one, I mean, I can't guarantee that there won't be more, but for right now, it's those large capital projects.
Questions? Yes.
Just for understanding, and maybe it's not how you do this, but wouldn't it be easier to draw a line of the capital projects so that we can see what is truly operating and what is real capital and have a better idea of what our deficits are?
I can do that.
Thank you.
And am I correct that we still have $10 million left from the transition fund that has not been allocated?
That's true.
This is the transition fund that we received from the state relating to the Medicaid sales tax. So, so we probably would anticipate using some of that money to balance the 2021 budget, possibly.
And that, yeah, that's one-time money. So we
Right.
just have to be mindful of that.
Right. It should be seen as a way of smoothing out and buying time to get expenses and revenues
Right.
in line. Is that correct?
That's right. So the initial $25 million that the county received, we did a portion over a period of 3 years. We have $4 million this year, 12.5 in 2019, and then the balance in 2018 of the initial $25 million. And then we did get 2 extra payments from the state, totaling about $10 million.
So we're using it in 2018, 2019, and 20.
Right, and then there'll still be a balance of $10 million.
But there's currently none of it programmed for use in 21.
That's correct.
Okay. Fine. Questions? Councilman Tron.
Thank you, Mr. Chairman. The money that was saved as a result of that hotel project that was reallocated to the queue, is that showing up, at what point have those funds left the account?
So the hotel savings, that's general, they were always general fund dollars.
Right.
A good portion of that got eaten up with the tunnel. So the tunnel was not part of the original project. That was, I think it was about 11.5 million was the tunnel. And then we have the operating agreement to maintain the tunnel with Hilton. So that's going to be an ongoing expense. And the rest of that would have just resided in the 0.25% fund. So I'd have to go back in my notes to see how much was left, but whatever's left is sitting in that cash balance right now.
But I thought it was committed, the hotel savings, when the hotel and the convention center savings, the convention center savings on the building was rolled over to the hotel. The hotel then was allocated in the queue expansion.
Well, the 0.25% fund was what was pledged to support the county's commitment to the queue.
Okay, and how much was that as far as both those items being under budget that would have been going into the general fund?
I don't remember offhand what was the balance left in that account after we paid for the tunnel, so I'd have to go look, but I know that the Q debt service is $1.5 million a year through 2027 when the tax sunsets. And then in addition to that, the 0.25% fund is going to have to pick up any increases in sales and admission. Well, we don't expect admissions tax increases next year, but in sales tax.
Okay, I guess I thought that you'd one time told us it was around $16 million that was being saved as a result of those savings from the construction on the convention center that then rolled into the hotel, became the foundation for that was saved on construction costs on the hotel, and then that was what was being rolled over.
I'd be surprised if I was the one that said that, but I'd have to go back and look.
Thank you.
Director, can you quantify, and I know this occurs through a couple of steps because we're kind of the backstop on this, but can you kind of quantify how much the extra hit to the general fund is going to be due to the fact that that our star LeBron James moved on to the Lakers and that being 2-12 or something like that, the Cavaliers are probably not going to make the playoffs this year. What's the impact of that?
$4 million in 2019, 2020. So the debt service is paid in advance. It's a pledge that we pay at the beginning of the year. So we had initially assumed when LeBron James left the first time, there was about a 50% decrease in attendance at the queue. So when he left the second time, we were initially assuming only a 25% decrease because I am forever optimistic about Kevin Love's ability to hold this team together. And then I heard he went on disability or something. So we have since revised our projections in third quarter that we're assuming now the same impact as when he left the first time, which would have been about it will be a $4 million hit in 2020.
Per year.
Right. Yeah.
Why is there no hit in 19?
Because we've already made the payment for, right, 2019?
Yeah, right.
What, can you come up to the table?
Brian Witt, Office of Budget Management. So with the Cavaliers in the Gateway Arena's debt service, the payment is based on a pledge that we pay at the beginning of the year. And what that is that's debt service less what the account balances with the trustee are. And admissions taxes are collected over that period, and that contribute to the payment on our behalf. So for example, for 2018, starting in January, all of admissions taxes were collected. That's offsetting our 2019 payment.
So we're getting the benefit of this year's activity is offsetting the 2019 payment. So it's not until the results from 2019, which are going to be much weaker.
Right, sorry, but 2019 does go up slightly, because the admissions taxes did take a hit in 2018. He left, I don't remember when he left, but there's a slight increase in 19.
Dale?
Chair.
Okay. Councilman Tron, and who else is requesting? Okay.
So are you taking in consideration that last year, season ticket holders were told they had to buy their season tickets before LeBron's announcement?
Yeah, well,
And there's going to be a high attrition rate of
Right.
people this year now that they know he's not coming back.
Right.
I mean, they were led to believe that he was coming back when they were forced to buy their tickets last year.
right. So the answer is, we're trying to get the data on that. We've requested from the Cavs, who are, like, how many of the season ticket holders did renew last year for this year. But
This
I
should
don't
not
have
be a
that data.
request. We are a partner, and we were told very explicitly when this body voted for that we were going to get the data points. We should be not only requesting, we should be demanding that we get the numbers. Because we're the ones that went out to the taxpayers and put our neck out on this.
Noted.
Could we get the numbers, please?
When I get them from the Cavaliers, absolutely.
Okay. Remind them, please.
I will again.
Okay, thank you.
And just for clarity, the numbers
Yeah,
refer to,
Season ticket holders that were told they had to buy their tickets They were told they had to buy their tickets last year before they were told as far as the status
Right.
of the renewal. I think you're going to see even a higher number than what you're forecasting that are going to drop out of season ticket holders this year.
That's what we're hoping. I mean, it's
Kevin Love.
unfortunate circumstances, because we're kind of hoping that the fact that they didn't get the information timely will mean that more people renewed their season tickets. And so then again, the hit to us wouldn't be until the following year, but I don't.
well, I'll say this.
I'm not a season ticket holder, so I can say that.
Well, I am. I've been a season ticket holder since 1993. And what they did, what the Cavaliers do, is that, and these are the years where LeBron was making the playoffs. If you wanted to buy playoff tickets, you had to sign up for next regular season, or you were not allowed to buy the playoff tickets. So if I wanted to see LeBron in the playoffs, I had to sign up for the next season. So the year he left, the first time he left, they were not, the language on the radio was, we're not rebuilding. Well, they're not rebuilding because they had the whole season ticket. The stadium was filled, even though they had a down year. But after that year, people dropped off.
Right.
So that's what, this year, I'm locked in, but I've only been to half the games. I've given tickets to other people and things like that. But they got the whole season locked up, just as if LeBron was here. Next year is when they'll take the
Right.
hit, and we will take the hit.
And that's what we're reflecting in our numbers, that we're going to take that hit in 2020.
Right. Okay.
Unless something happens.
Unless Kevin Love comes
Yeah.
back.
Well, we get the number one draft pick, and we pick,
Since,
Or that.
yeah.
since you have season tickets, when you see LeBron on Wednesday, tell him we still love him.
I will do that.
Okay. Do you have anything more, or is that it?
No.
Okay, anybody else?
Question.
Ms. Baker?
Putting aside the season ticket holders, how about just the admission taxes in general and the merchandise that we also receive? Is that been also evaluated as to what losses there'll be there?
Yes, so the sales tax data we are finally getting quarterly from the Cavaliers, and that's performing, originally the baseline was 250,000, so we need to recover or make sure that there's at least 250,000 in taxes generated. And I believe through third quarter, it's 375,000 for the year. So we're doing good on sales tax, that's still up. We are not assuming that that trend is going to continue, though, if half of the stadium empties out next year. So like I said, we are assuming that 52%, I think it's 52% decrease in attendance next year. And that's going to have a ripple effect not only on the admissions taxes, and the county does pay, if the admissions tax revenue doesn't come through, then that's general fund, and then also on the sales tax. Now, one thing to note, just the way the Q bonds were set up, if admissions, the playoffs admissions taxes were pledged and sales tax above that 250. If we fall short, the county has no obligation to cover the difference. It's going to come from reserves. If it goes over, then the county does have to make that payment, which we did
And when you're
this
talking
year.
about reserves, in this case, it's not our reserves.
No, not our
it's the
reserves, correct,
project- it's
right,
the-
from
It's the
the
project's reserves.
bond reserves, right. So we will take the hit on the gateway debt service because that's what we use our admissions tax revenue for. We may take a hit on sales tax in general. I don't think it'll be substantial enough, given the amount of sales tax that we generate every year. But we will not have to come up out of pocket for more money for that Q debt service if things go south at the arena.
If I may, and is that if the reserves are what they should be, if the reserves are depleted? And I think there's two pots of money, is that right, in the reserves?
They're-
It's complicated.
It's
but-
complicated, there's
Yeah.
more than two, but if there's like no money, then the Cavs have to pay.
Okay,
The Cavaliers cover when there's like
When the reserves are
everything
depleted.
has been depleted.
okay.
Ms. Brown?
Thank you. Part of I'm guessing part of that anticipated decrease is that the fact that the queue will be closed completely, I think, in June of 2019 to finalize renovations. Do you have that accounted for? They're gonna take, it will be some time.
Yeah, do you? They were closed this year too for a couple months for the renovation, so it's in this year's numbers. I don't know offhand, I'll look if we have it in next year, but it probably wouldn't be a substantial amount.
Okay, they're gonna be, I know that, I just left a meeting for the Greater Cleveland Sports Commission, so I don't have the
Okay.
exact time frame, but
I'll double check our numbers, and like I said, they were closed this year also for, it was a good 2 months, I think, where they didn't have any events.
Right.
And there was a little bit of a dip, but it wasn't anything that was,
And I guess on
Freaking us
the positive side, the sales tax are not simply just associated to Cavs games. They're all of the
That's correct.
events.
That's
So
correct.
concerts, other sporting events. So there is opportunity.
any activity in the queue.
Thank you.
The Cavaliers are only about 20% of the events at the Q, so that helps spread it around. Please proceed.
So the next two slides, I'm not gonna go into a lot of detail, but I just wanted everyone to have it available. This is just an update on the county's outstanding debt. As everyone knows, at the beginning of the year, we had about 1.6 billion in outstanding debt. That's combined. At the end of this year, it'll be about 1.5 billion. Our projections assume that we will have no new debt issues. We have one retirement this year. That was the bonds issued for the Rock and Roll Hall of Fame. So I've detailed here what our debt service payments are through 2025 and given some explanation for increases and decreases. We are making some assumptions relative to the revenue bonds that are largely paid for by TIF, that tax increment financing. For right now, the TIFs are covering Steelyard, Weston, Public Square, and the East Bank projects. The TIF is not covering the Shaker Square project, so we contribute, fluctuates each year, but we contribute a small amount of money to Shaker Square debt service. And then again, we are assuming that all of the loans that were issued by the Department of Economic Development through the proceeds of the brownfield and commercial loans, that they're going to be repaid. So the next slide gives an update, a little bit more detail on the three larger issues that still had bond proceeds outstanding that haven't been spent in full. So the first one is the excise tax bonds that were issued in 2015. That was a $60.5 million issue. As you recall, that was to fund improvements at Progressive Field and Q Arena. To date, almost all of the bond proceeds have been spent. We have just a little bit remaining. We have collected $12.1 million in excise tax revenue through the third quarter of 2018. Debt service on these bonds is about $7 million a year. The second one is the 2016 sales tax bonds. These were issued for the Huntington Park Garage redevelopment project. That was a $21 million issue, bless you. They have been spent in full, the full $21 million. It's being repaid over a period of years by the county's garage fund. And that debt service this year was $740,000. It increases to $1.5 million next year and stays at that higher rate for quite a few years. And those bonds mature in 2037. And then finally, we have the 2017 sales tax bonds. That was the Q Arena that we were just talking about. That was a $141 million issue. To date, almost $60 million has been spent. The general funds contribution, as I mentioned previously, was $1.5 million. That comes from the 0.25% fund. We also did have to make a payment for the additional sales tax that was generated above the $250,000. And those bonds mature in 2035. Any question on debt?
Am I correct? For the 2016 sales tax, is this the one that we essentially internally funded?
Yes.
And thanks very much for these two slides. This is something that we don't normally spend as much time on, and these two slides give us a very good overview. So that was very useful.
Mr. Chair?
I think you could do that again in future updates.
I plan to. It's
Yeah.
a substantial part of the budget, unfortunately or fortunately.
Right, okay, thank you.
Chair?
Yes.
Back to the previous slide, could you help me understand, if we have 1.6 billion in debt, outstanding debt, how much of that, walk me through if the slide shows it, how much of that debt is covered by revenue generating?
So the second chart on the top right there, which shows the general fund obligation, that shows how much the general fund is paying. So in 2018, we're paying, this is so, like 81 million in debt service will come from the general fund.
From the general fund?
And then what's the total? The total, I can't read this because I can't see. What's the total?
110 million.
Okay, thank you. 110 million. So that's covered through TIF revenue for a lot of them, or other sources. Admissions tax, the gateway, again, the 1992 bonds are paid for by admissions tax.
So 81 million is, the number was 81 million from the general fund,
Thank you. From the general fund, yes.
and the rest is covered by
Yes.
dedicated revenue sources?
Yes, and the general fund ones, we have some single large ones, right? So the Medical Mart is over $30 million a year, the hotel is $20 million a year. So those two alone are a substantial portion of the general fund's contribution. And then we have the general obligation bonds. There are 3 issues still outstanding there that comes from the general fund too.
But only 81 million from the general fund?
Only 81 million.
Only 81, yes.
Yes. And we will see some, there's some slight relief in future years. So you can see that it does go down a little bit. The way the bonds are structured, which was smart, we have some pretty substantial decreases, like in the general obligation bonds. One of them goes down by 4 or 5 million, and then another one's going to retire in the next couple of years. But then the sales tax payments jump up. So the way it was structured, it was meant to keep it consistent in the general fund, but you can see there is some slight bit of relief in the next couple of years.
When does the medical market pay off?
When does the medical? Okay, I'll let you know.
Okay, fine.
37? Well, I'll let you know. Any other questions about the debt?
Okay,
Okay.
HHS.
Medical Mart? 2027 is when the Medical Mart bonds expire.
Okay.
So that makes sense, because that's when the tax sunsets. So the additional 0.25%, was not legally levied for the Medical Mart, but it all happened around the same time, so we draw our own conclusions. So the debt service would coincide with when that tax sunsets, and that's the same for the 2017 Q bonds. Okay. HHS. So, as everybody's well aware, we have 2 voted levies for health and human services. In 2018, we are projecting an operating deficit of about $10 million. That means that our expenses are greater than revenue. We are also projecting that we're going to be $6 million over budget, so that right now our projections for total expenses exceeds approved appropriation levels. The majority of that is actually attributed to the reconciliation of our controlled costs, which are space costs and indirect cost plan allocation, which essentially allocates some of our administrative costs to the other county, general fund administrative costs to other county funds. So when we did the reconciliations, the Health and Human Services levy funds, because they represent a large part of the budget, did get a pretty good size hit. We established, if you remember, in the budget, a $7 million reserve for the Department of Health and Human Services. That has been drawn down to $970,000. And we are, based on our projections now, we are projecting that we're going to be compliant with the cash balance requirement of 10%. Our future year estimates assume no change to the level of support to the Adams Board and Metro Health. Those are both not mandated, but the county has contributed to both of those entities for at least as long as I've been here. So that's going back 12 years or so. In 2019, assuming no change to revenue or in expenditures, though, we are projecting that the cash balance is going to dip to $4.5 million, which is only 2% of total expenditures. And then again, assuming no change, we are projecting that the cash balance will go into the negative in 2020. And if we didn't make any changes, we would have to bring over $17 million from the general fund.
So what's the deficit projection for 2019 and 2020?
So for 2019, we are projecting an operating shortfall of 19 million. For 2020, it's 21 million. And this is, I'm sorry, but this assumes a 1.5 increase in the subsidies to each department. Beginning in 2019 is based on what we know, or what we think we know is going to happen. And then the 20 through 2022 is assuming a 1.5% to compensate for personnel, the increase in personnel costs.
And what's the 2018 year-end PA balance projection?
About $10 million. And we are not assuming a drawdown of that.
That's kind of getting down to regular operating level.
Right. Right. Considering this, the amount of activity in all of those funds, $10 million, I'm, comfortable leaving it there. I've always been pretty uncomfortable with large balances in the PA fund, but you could have a $10 million swing in revenue in this budget. It sounds like a lot, but it's really not, just because combined, we're looking at $600 million in an annual spend.
Well, we had a $6 million swing this year.
Right.
Okay. Questions? Councilman? Councilman Tron?
Yeah, on your two assumptions that you have, I assume that there'll be no change in the level of support for the Adams Board or the Metro Health. What are the numbers that you're assuming that it will be no change on?
So Metro is 32 million and Adams is 39 million.
Okay, so between the two of those, looking like.
I'm just double checking.
Okay, so we're looking at $71 million. Is that what you?
32 and 39.
Yeah, that was just my rough back of the envelope. So that is an area where if the assumption does not hold true, that if it's some number less than that, there would be a place to do some of the number balancing that you're talking about.
Absolutely.
Thank you.
Okay. Councilman Jones?
Just wanted clarity on that point. The 32 and 39, is that for 2018, 2019?
We're assuming that in all 5 years.
All five, that's the same as it has been in 2017?
That's the same as it was in 2017, I believe, yes. I might have to double check that one.
I believe
But there
it
was a
was.
cut,
Was, okay.
maybe the cut was 16 and 17 then, and then they were held harmless in the 18-19 budget.
Okay.
I think that's right.
Yeah, and
I agree.
I'm not even sure that both of them were cut. But if they were in 16 and 17, of course, they would say it was a substantial cut, but it was, I think, a couple million, which is substantial. But again, when you're talking about 70 million.
Councilman Tron?
But also during that same time frame, we did do some substantial increases to the Adams Board during those periods, in the years in which we've been in, as running into the new form of county government also, do we not?
That sounds right. I would have to, okay, so it's a trick question. Yeah.
I can help with that.
Okay.
There was,
I just want to
was
hear it
a-
coming from your voice as opposed to.
I mean, I'm pretty sure that's true, but I don't have it right in front of me.
well, after the levy increase passed in 2013.
Right.
We increased the allocation for the hospital and the Adams Board.
Okay. I mean, so I can definitively say, at least looking at mine, that they've been the same since 14.
Is it possible to give us the?
But yeah, I can get you by year.
Give us the run rate for the 10 years that we've been in
Absolutely.
existence here, the run
Absolutely.
rate for both those?
Sure.
Thank you.
Sure.
On an annual basis.
Yeah,
'Cause then,
absolutely.
Obviously, if you take the 71 times the 5 years that you're talking about, we're talking $350 million that 5 years will represent.
Yeah.
Thank you.
I would just, not totally my area of expertise, but I would also say that if we're looking at these two, we should look at the impact of Medicaid expansion on the two entities, because that would have increased their Medicaid revenue.
I do believe Metro was up to 40 million in 2014.
That sounds right.
Anything else? Continue.
Okay, so this is looking at the county budget on an all-funds basis. So again, as it stands right now, until we implement the ERP, all funds excludes some grants and capital projects. The general fund's contribution to capital projects would be included in these numbers, but not any other outside revenue sources. On an all funds basis, our revenue is projected to total 1.5 billion. This is about 2% more than we anticipated in the budget. I have some justifications for why that is. On the expenditure side, we are $156 million, which is 8% under budget. 24 million in self-insurance, which is how the county covers its employee benefits cost. Department of Development, 23 million. That largely reflects just the timing it takes to actually get their loans and contracts out the door. So when council approves an economic development loan, we will appropriate it, but then the department is still negotiating the details of the contract, so it sometimes takes quite a while to get those out. And then Public Works, Sanitary and Road and Bridge combined, we have about a $30 million budget surplus. That's not uncommon. They are typically significantly under budget every year. And the Board of Developmental Disabilities, we're projecting about an $8 million budget surplus. And for the board, that's largely reflected in their personnel line. They have been decreasing staffing levels for quite a few years. I think I had a chart in the last update I did, but the board has been shifting from the provision of direct services to contracting, and that has resulted in decreased staffing levels. And that trend is expected to continue for a few years.
So you said there are certain things that even the all funds budget does not include.
Yes.
Can you give us a rough ballpark on how much money that we're talking about?
I will like to say that I'll respectfully get back to you, but I generally say that we have about a $2 billion budget, and 1.5 is what we reflect in our schedules. So that can fluctuate, year to year, depending on when capital projects, if you have a big project, that's gonna jack that number up. But I would, at least a couple $100 million for sure.
So what kind of items are not included?
Capital projects, so any capital project that does not have general fund support, a lot of road and bridge projects, some of the sanitary projects, some are included in the operating budget and some are not. That's actually something that we're working on, because I can't confidently say why it is. That's one of the things that's just always been what it's been. I'm sure there's a reason for it, but I haven't dug into it yet. And then categorical grants. So the Office of Homeless Services, for example, what you see in the schedules is that they're about a $9 million office, because that's what they get from the HHS levy fund, but they receive over $30 million, at least based on 2017's numbers, they receive over $30 million in HUD grants. And that's not in our numbers.
And what kind of things are in the all funds budget that's not in the HHS levy or the general fund?
So the all funds budget will include most of the special revenue funds in addition to the general fund and the levy fund. So keep in mind, when you look at a balance sheet, for lack of a better term, for the levy fund, what you're going to see is the 236 million that comes in, the 250 or whatever, depending on the year, how much money is going out. But the money going out only represents the subsidy to other funds. So for example, the Department of Children and Family Services is a $150 million agency. They only get 60 million from the levies. So all their other revenue sources will be included in all funds revenue.
But if they receive a categorical grant, it would not be included.
That's correct.
Yes. And when we get the ERP in place, is it going to include everything?
It is going to include everything, which is exciting. But so, I mean, just, it is exciting. I'll be like Zig and focus on the good news. But I mean, one thing that we're just trying to work through right now is making sure that we can distinguish between what previously had been excluded and what's now going to be included. Because so for example, just using homeless, they are a $40 million entity last year. If I include the grants, it's going to look like they went from 8 to 40, even though they were 40 the whole time, if you're following me. So I just want to make sure that we can clearly identify in our schedules the grants that are now reflected that weren't reflected before, but that actually aren't new.
Well, we'll keep that in mind.
We'll
But
figure it
for-
out. I mean, so
but
we'll be able to let
fortunately-
you know.
The all funds budget is not something we really heavily focus on. The major focus is mostly on the general operating fund, the general fund, and the HHS levy fund gets most of our attention.
It does, and I will just draw your attention, I think, not normally, always in my reports, I do include a section on fund balances. So I do pick and choose which ones I would like the council to focus a little bit more attention on, because either there's too much money or there's not enough money. I mean, the special revenue funds, for some of them, we will want to pay more attention because it's going to become an issue in future years. And if you have an activity that's supported by a special revenue fund today, if that revenue is insufficient to cover it, we either have to eliminate the activity, which could have moral, political, real social consequences, or you have to fund it with the general fund. So they do overlap. I do try to draw your attention to the ones that I think we need to look at more closely right now, because it's a $2 billion budget. That's a beast to get a handle on, but we don't pay, I think we could pay more attention to the all funds budget.
Okay, good to know. Any other questions on this section? Seeing none? Yes, Council.
Well, to that point, there was a deficit for the all funds. Did I read that correctly?
Well, the all funds budget, no. So we don't, because it's a collection of distinct funds, we don't look at it operating shortfall deficit, because it'd be improper to combine them all, because I can't, we can't use an excess of revenue over here to cover a shortfall over here. So we specifically don't refer to deficits. If there were a specific special revenue fund that had a sizable operating deficit with no cash, I would have told you about it. And I don't think I told you about any in this report, which means we don't have to worry about that right now.
Gotcha. Okay.
Okay? So the next slide is just a brief snapshot of staffing levels. In 2018, we're projected to end the year with about 7,400 FTEs. That's 300 fewer that were anticipated in the budget and 34 under last year's levels. So we have a couple of agencies that have fewer FTEs this year than we expected in the budget. That includes the Board of Elections, the Board of Developmental Disabilities, Job and Family Services, and Juvenile Court. For Board of Elections, they ended up needing fewer temporary staff and poll workers to work work for the election, so we didn't know that at the time that the budget was developed. I discussed BODD already for Job and Family Services. Their overtime has actually gone down, so it was much higher last year, and overtime is included in the calculation of FTEs. Juvenile Court, they've also, earlier in the year, did see a pretty good size decrease in their overtime in the detention center. Agencies that are over budget, over FTEs, so they're not necessarily over budget, but they are over the budgeted amount of FTEs. That's the Sheriff's Office. Both regular and overtime hours are up in the Sheriff's Office. The original budget also didn't include the FTEs for the new Bedford facility, because we just had no idea how many were going to come. So as they've been hiring new staff, those are now included in the numbers. Children and Family Services, their overtime is through the roof. I do talk about that in the report, so I want to draw your attention to that. They have been up every pay period over last year. And then Public Works and Road and Bridge.
It sounds like the Board of Elections going to electronic poll books paid off some benefits.
Absolutely.
Okay, Ms. Brown.
I was curious also, was there any contribution to the reduction of precincts and?
Yes.
Okay.
Absolutely.
All right, thank you.
Councilman Tron.
Yeah, this body started not quite 10 years ago. And as I recall, there was supposed to be reductions in operational headcount. And anybody that I ever know that's ever done an ERP would be looking at anywhere from a minimum of 7 to probably 15% efficiency improvements. I don't see that in any of our numbers. Our headcount looks like it's been flat from 2011 when we took on board to where we are currently right now. So
I'm sorry.
is that the correct way to read your slide? I mean, I think that the previous county executive did do a slight reduction those first couple of years, but that's been about it.
Right. So there was, you're right, there was an immediate kind of decrease as soon as the transition happened, and then it creeped up a little bit in the later years. In our projections, we are assuming some decreases in staffing levels related to the ERP. I included our assessment in the third quarter report that I sent you to, so I won't go into it in painful detail. But we got information from the largest affected agencies, so that's fiscal, we prepared it for fiscal, HR, Public Works, and IT. Based on what those departments told me, I have those decreases reflected in the number, but they are not 7 to 15% at all.
Are they 10?
No. For HR, it was 6 FTEs, I believe, and HR, I'd have to look, but they certainly have, there are 100 or so FTEs. IT was going to increase FTEs. Public Works is going to increase FTEs, but that's actually understandable because the way they're saying that they'll be able to do more work.
Right, we're going to increase
Right.
revenue, hopefully.
So, and that's good
Right.
news. It will be more productive with hours in the day. And the fiscal office, our decrease was definitely over 7%. Might be over 15%. I'd have to check for all of them, but I know like OBM's was 14%.
Thanks for doing your part.
You're
Yeah,
welcome.
Right.
So
Because that-
those, no, I'm sorry to cut you off, but those are in here, so I would look at that memo that's in the back of the report. And we have also included now, which we didn't previously do, but we've also included the savings associated with some of our legacy systems beginning in 2020.
Okay, so that's really what a lot of us keep asking. If we're going to spend $25 million, it should be showing up on this particular slide. Of all the slides, we should be seeing it on this slide.
Well, I'm showing
I-
you what I can show you, but the combination, the cost of our legacy systems combined is less than the cost to maintain the new system. It just is. And then the staff, so where you're really going to see a decrease would be potentially in the staffing levels. Like I told you, I'm only as good as the information that I get from the agencies. So one of them told me 6 FTEs, one of them told me they're going to increase FTEs, Public Works, I forget offhand, I know they're gonna increase, but we're all really happy about that. Fiscal's gonna decrease, that's in the numbers, but that's, I hear you on what we should be seeing. I mean, I've never done one of these before, but intuitively it makes sense. You're not gonna get your 25 million back. But I am very reluctant to anticipate savings that I have absolutely no data to suggest that, because I don't want you to make decisions assuming you're gonna see this million, 2 million, 3 million in savings, and then I'm the schmuck that stands up here one and says you're over budget by $1, $2, $3 million.
And only because he's a broken record and he keeps raising this issue. I don't want to take his thunder, but my colleague to my right keeps suggesting concepts about buyouts and headcount reductions and things like that. Do you have forecasted possibilities and what ifs if that were to be done as far a buyout? And it's this, all that thunder belongs over here. 'cause
No, I
he has
know.
been- He has been, no, you know my style. It's not to take credit, it's to give, have you
Right.
done? Yeah.
So we have the data and we're analyzing the data, but I can't tell you right now whether that's in the county's best interest, or I would recommend that that be in the county's best interest at this point, because I just received data recently.
Okay, thank you.
Anyone else? Councilman Gallagher?
Can you think of any other project or program that you could implement over, say, a period of 3 years that would lessen the amount of employees by the county by 10% and therefore save the county maybe 20 million a year for those 3 years? Is there any possible program out there that's better than that? Because I would think that would be in the best interest of the county of Cuyahoga, Ohio.
I am likely to agree with you. My only caution is this, and you know this. If you spend money when you buy these people out, like that's a legit, we are buying these people's time. And I agree it has the potential to save millions of dollars. When the county did the buyout in 2009, we lost over 800 FTEs. And it's a substantial saving. So our charts would be way higher these days if we didn't have the buyout. The key to the buyout, however, is maintaining service level provision or provision of services. So again, not my area of expertise, but I don't know how you do it in a children and family services right now. And maybe you can account for that. But then also restricting your replacements. So if
Absolutely.
you buy people out and then we don't restrict the replacements, I don't want to come up here anymore and have to present those numbers.
I don't
So
mean
I
to put you
agree
in a-
with, no, I know, I'm just making a joke. But I agree with you.
I always
It
use
is the
the
best
tag-
program, but we have to be very deliberate.
I always use the tagline, done correctly.
Done correctly.
Because because in our not so recent past, it was done incorrectly for all the wrong
It
reasons.
was done incorrectly in 2001.
The 5-year was incorrectly
Yes.
done,
I agree with you, yes.
and that led to other
Yes.
problems. In '09, you didn't see any problems anywhere replacing people, replacing services, providing services to the point where it was so devastating to the world that things came to an end. I always hear this end of the world scenario. And you know what's interesting? Now I'm going to get on the soapbox. Is that we all think we're so important and we're all so good and so special. And there are people in this county that are special and we really can't lose them, or we have to figure a way in which to maintain their services. But there are other people waiting to come on board to do the special, important things
I
too.
hope I'm in the latter category.
I don't
But,
know.
no, no,
it's-
but
it
I
just-
agree with you, and you know,
But
when
done correctly.
absolutely.
You are absolutely right.
I've been here a long time, and we don't always do things correctly, so I just have to, I'm a bit cynical.
It's a delicate
yes.
balance, I agree.
Yes.
But it's important that those at the top that are running it understand the delicacies.
Absolutely. And so we're looking at it. I mean, that's our job. I will analyze every possible scenario to save the county money without impeding services.
But it is
We
important.
can't say yet.
Historically, we've not had a problem with a buyout, with providing services. We haven't. And I refuse to listen
No, in
to anything.
2009, it was the exact, I mean, it was the opposite. We
I know
lost some
that.
critical positions at least I'm just speaking for fiscal, but we lost some really critical positions and we survived.
And you had a new organization come in. and we survived
We
ourselves.
survive everything. I mean, the people are resilient.
We are like the children, resilient, thank you.
Yes, we are.
Director, suppose we put in a policy that for the next 5 years that everybody that retires, we're not going to replace more than 10% of them. And applied this policy for the next 5 years. Am I correct that we could get the same kind of reductions that we could get from a buyout without having to spend all the money buying people out, except that it would just take longer?
I don't believe so. I've had this data a while ago, and I did ask to get it revised because it's been a year or so since I looked at it. But just based on the number of people who had years of service, and again, if they don't have to leave, so we have people who've worked here 40 years. But no, we would not receive the same benefit because in some cases, the people that were leaving, you were going to have to replace the positions. So you got a director that leaves, or you do have to do some replacements. It's unlikely that you can do a buyout and then just watch 400 people leave and not do anything. But no, I don't think we would get the same benefit because we won't get the same volume. We do have a good collection of people who've been here over 30 years, but it's nowhere near the level of people who've been here for 26 years or 27 years and would be eligible for a 3-year buyout within the next couple of years.
And what's the projection on how many people are going to retire from the county in 2018?
I don't do that would be a question for the Department of HR. I don't do those projections.
Okay, fine. Other questions? Councilman Tron.
I'll just make the comment that combining, hopefully, the efficiencies that we saw of Public Works with the ERP with a buyout is where you should be getting the technology improvements of the two together. I mean, that really is where the perfect storm should come together for the benefit of the county.
I hope you're right.
I hope so too. We got a lot of money invested on the one, and the other one is obviously, as you point out, it's a big investment to do a buyout too, if it's not done correctly.
Anything else? We're going to have to balance the 2019 budget in the first quarter next year, and we're going to then have the biennial budget later on in the year. We're going to have difficult decisions to make. The Health and Human Services projections are particularly a concern. We only approved the levy for 2 years. We're going to have to look at what it is that we put on the ballot in the spring of 2020. We're going to have to make that decision probably in September or so of next year as we go into the budget process. So we have big decisions to make over the next year.
Can I ask a question? Is your expectation that we're going to be submitting a plan to balance the 19 budget within the first quarter of the year?
That's my expectation. Not 20 or 21,
Right.
just 19.
Okay.
Is that your expectation or no?
No, I mean, this is the first I'm hearing of it, but okay.
I mean, you wouldn't want to wait till you're halfway through the year and whatever measures you have to take would only be operable over 6 months. That would make it much harder. Am I right?
No, I understand. I just wanted to clarify that.
Yes, that's my understanding. We're gonna talk with the executive and try to get some understanding more precisely on the timing, but I think it has to be sometime in the first quarter.
Okay.
Okay. Anything else? Thank you very much. You put forward a fine report that was very informative. We appreciate the
Thank you.
work that you do. Thank you.
No, so one of our staff members created that a few months ago. It's great, isn't it? Yeah.
Okay. Item number 6, matters referred to committee.
Resolution number
Miss
2018.
Janine,
Resolution number 2018-0234.
sorry, Ashley.
Authorizing the sole source contract with Manatron, Inc. in the amount not to exceed $593,589 for support and maintenance services for the Manatron Visual Property Tax System and Sigma Gamma software system for the period 1/1/2019 to December 31st, 2019.
Good afternoon, Debbie Daftovich, Department of Information Technology. This is an annual maintenance agreement for our MVP software and our CAMA software. So it relates to the real property tax system and the CAMA system, which we are currently upgrading. That project began in 2005. It was anticipated to be a 3-year project. We amended the contract to add the appraisal portion to it. We had anticipated we would be going live towards the end of this year. However, we've had some project delays and we are currently looking at rolling into next year. So this contract is for the existing system to support it while it's still live. We do have a 30-day out on this contract, so should we choose to shut down the system at any point in time, we will provide notice and the contract can be ended.
So, is the new system with an entirely different company, an entirely different contract?
Yes, it's a completely different company and contract.
And is the delay in getting the new system up and running going to cost us money, or is it kind of neutral?
It's cost neutral with the exception of keeping this maintenance on for the additional time period. The contract was negotiated as a cost not to exceed, and we are currently under budget, and we plan to continue to be under budget.
And is the amount the same as it was last year, or is it more?
I believe it is the same as last year. It is the same.
And is this paid for by the Real Estate Assessment Fund?
Yes, it is.
Okay. Questions by my colleagues? This doesn't go into effect until January 1, so it would not seem that we need suspension. Is there any need?
I don't believe so. I think we have time to
Okay.
get it fully executed.
Okay, so if there's no further discussion, would someone like to make a motion to refer this item to the full council for second reading? So moved. It's been moved by Councilman Tron, seconded by Councilwoman Brown, to move Resolution 2018-0234 with a favorable recommendation to the full council for second reading at the next council meeting. Any further discussion? Hearing none, all those in favor say aye. Aye. Any opposed say no. It is so
Thank you.
recommended. Okay. Ms. Ashley.
Resolution number 2018-0235, authorizing amendments to various contracts in connection with a master services agreement with Key Bank National Association for various program services for the period 5/1/2014 to December 31st, 2018, to extend the time period to December 31st, 2019, and for additional funds.
Thank you, County Council. Chris Murray, County Treasurer here, presenting an amendment for time for our Key Bank master contract. This covers approximately 12 accounts. We're extending that particular agreement for time due to the fact that we are still in the midst of both our ERP implementation as well as the real property implementation. The contracts include extensions for the corporate travel card contract, and also the procurement contract for fleet through our Department of Public Works. The the corporate contract is actually a 17% increase. The procurement contract is, the commercial fleet contract is actually a 15.6% decrease. As you know, the various county agencies use our procurement contract. I have a list of them here, and it pretty much runs the gamut, everything from Board of Elections to Health and Human Services departments. The contract, the amendment that I'm bringing forth also includes changes to the language of our existing key agreement so that we can incorporate a data piece that we need for implementation of the real property system. Essentially, what this is going to allow is for various for payments that come from multiple different banks. They will be consolidated by KeyBank and provided to us in one file. So it just makes it easier for our daily processing. I'll take any questions.
Director, does this contract include everything that we do with KeyBank or just some of it?
This includes the banking relationship, so that would be the accounts, also the fleet, the fleet procurement.
So it includes all of our relationships with KeyBank?
That is correct.
Okay. And does this total amount to 250,000, the 129,300, and the 230,000? Does all of this money go to KeyBank for services they provide, or does some of it include the cost of the cards themselves?
This is for the service, which I'm assuming is also includes any plastic that's needed. Is that what you're talking about? Is that what you mean?
So these amounts are the amounts that KeyBank receives in fees for providing these services. Is that correct?
That is correct.
Okay. And does this contract go away, or is it otherwise impacted when the ERP system is fully implemented, or will we still need these contracts?
We will still need these contracts because Ohio Revised Code requires all county treasurers to have a contract of this nature for our banking services. What will happen, we're extending this contract now through 2019 in hopes that once we are finished with ERP, we are able to have our wide-ranging RFP available for all banks. As it is right now, it just wouldn't make sense to include or the possibility of a new bank while we're in the implementation phase. Key has been a good partner with us while we are working on both systems, and this is just in terms of practicality. We need this through the end of next year.
So this is interim legislation, and then once the year is up and the ERP is in place, we're going to put a new process in place that might involve working with multiple banks on a competitive basis. Is that correct?
That's my goal. Actually, the RFP process will start concurrently while we are working on the both system implementations.
Questions by my colleagues? Okay.
Chair.
Vice President.
Okay, thank you. Chris, thank you for the presentation. My concern is the kind of the bigger picture of how we interact and conduct contractual work with this bank and the other banks, not just KeyBank. We know the challenges in this county in terms of housing, the taxes generated and collected, and the role that housing that the banks play in extending the necessary credit. Okay. I know my understanding is next year we're supposed to, if this is interim legislation, we're supposed to do a master contract with all banks.
That is correct, and we're going to include some of your concerns in the negotiation. I'm working with Department of Development on that.
Okay, so you'll be working with Department of Development. Help me to understand what that looks like. Will you be sitting down with the banks, or what's going to happen?
We are, the banks will receive the RFP, and there will be a portion of the RFP that will discuss their commitment, and we'll be able to come up with a quantifiable score per se for those services. And then once we've picked our main account, which is what Key is right now, then we can start the heavy duty negotiations with that entity.
Okay. Is there anyone from the council part of that negotiation?
I do not believe anyone from council is a part of it at this point, but I am certainly aware of the interest in that contract, so I'm working on it.
Is there any opportunity for our staff to audit at the very least,
Audit the,
or in a sense be present?
we can certainly, I mean, if some of your staff even want to sit in with some of the discussions, that's no issue with me.
Okay, excellent. As I said, we've gotten quite a bit of transactional benefit from the banks, but they have opportunity to do some transformative things that can help. And we have, obviously, the housing plan has been mentioned. Those things, as they come together, that should all, I think, should dovetail together and allow them the opportunity to do their fair part.
Agreed.
Okay.
Okay, that's good. We're gonna participate in the discussion when we go into the full contract. That's important. Councilman Tron.
Do we have funds on deposit then with Key Bank?
Yes, we do.
And I guess I was under the impression that our funds deposit was the offset against the fees, as opposed to seeing, what, you said 15, 17% increase? I thought that was an offset, that we were supposed to receive the benefit from our deposits.
Well, I want to make sure the distinction's made. The increase in the corporate credit card program is due to additional agencies needing the service. So it's
Okay,
not.
so it's just a usage fee, it's not a.
Usage, it's because the usage changes on an annual basis.
Okay.
Procurement manages that interplay between the departments, and then we bring the total dollar amount to council. So.
One of the things that I believe some of us have raised, with the interest rates going up, are we getting our fair dollar return based on the credits that we're getting from the bank by them sitting on our funds out there? And I think you were going to go back and crunch those numbers to see whether we're getting our fair value, or are we better off just getting the interest earned on our money and just writing a check for that, as opposed to them sitting there and doing that as an offset? Have we done that?
But right now, we're still using them as an offset, and I have not been able to crunch those numbers.
How many dollars do we have on deposit right now with Key Bank?
I think the last bank statement was approximately 80 million.
And
Now that's moving. Remember, that's moving daily, depending on what the rates are. It could be sitting in Star, Ohio right now.
And what are the Fed funds rates right now, as far as the earnings on those?
I believe it's.
Okay, well,
I don't remember.
About 1.75.
Yeah,
it's a little higher
I was
right
going to
now.
say 1.6 or something, but
as far as our short-term rates from Star, Ohio, what do
they're
we make?
outperforming. They're outperforming.
They're outperforming that number.
You bet.
Right,
You
yeah.
bet.
So what I would ask is to calculate whether or not we're better off using our money as opposed to them using our money and just writing them a check. So I think that's,
Okay.
I know we've asked that before, and as interest rates keep going up, it becomes even more and more valuable for us to be earning money on our money as opposed to doing an offset in that respect. So with that, and then my colleague was asking about programs that the bank might be putting in play. The bank, like anything, every program costs them money that they offer out there in exchange.
Correct.
Whatever we put in and request, we should ask, what does this cost the county for all our 1.3, 1.4 million taxpayers. So we make sure we understand the cost of that. Again, if that costs us money, then perhaps the better use would be to just put money into a program that, that the Vice President wants to see, as opposed to using our money in exchange for services from people, because they generally charge more for those services when they do that. Thank you.
Director,
Yes.
I think my colleague is totally on target. The interest rates have gone up markedly on short-term money. Things just aren't the same as when the short-term interest rates were 25 basis points. I think it's very important that you do that analysis that he recommended, and that you do it quickly. And I would like to request that you get back to us within 2 weeks with a preliminary indication of what it's looking like.
So you want to know the delta between,
What we want to know is whether the amount of money that we would get in interest from what we have on deposit. My thinking is that it would be more than enough to pay for their fees, with a good bit left over, and that we would be better off to pay for the fees in cash and get the interest on our money, rather than what we're currently doing, which is using the interest as an offset.
okay, all right.
I'd like to get a report in 2 weeks. We won't necessarily have you come to the committee for it. You can just
I'll send it.
just send it through the clerk. Okay, great. Anything else? Okay, Vice President Jones.
Just that I support all that I've heard from both of my colleagues. You've heard from just a small sample of this council, but again, your negotiations I think are going to be critical. But you've heard, I think, an excellent point. And those we could get our full interest. There may not be a need for discount, so you can be able to take that with you into those negotiations.
Great.
Okay, anything else? This one looks like the other one. On the appearance is that it doesn't go into effect until the beginning of next year, and we wouldn't seem to need it passed under suspension. Is there anything that we don't know about?
Yes, Councilman, the portion of the amendment that I discussed, it's called bill concentration services. I actually do need that. The consultant needs access to Key's data in order for us to continue with the implementation. So if the council is amenable, I would like to try to get this passed as soon as possible.
Okay, we will accept that request, and I'll ask my colleagues if someone would like to make a motion for second reading suspension on 2018-0235. Okay, it's been moved by Councilman Schwan and seconded by Councilwoman Brown to favorably recommend 2018-0235 with a recommendation to leadership to place this on the agenda at the next council meeting for passage on second reading suspension. Any further discussion? Hearing none, all those in favor say aye. Aye. Any opposed say no. It is so recommended. Is there any miscellaneous business? Hearing none, I'd like to thank everybody for their time and attention and wish everybody a very happy and thankful Thanksgiving holiday. And with there being no further business, we are adjourned.